IRS Schedule E, Supplemental Income and Loss. So taxpayers will generally file Schedule E with their income tax return to report income from sources that are taxable but not necessarily subject to self-employment tax. So for items that you don't receive a W-2, you don't receive a 1099 from a financial institution, you're not receiving capital gains treatment. This is simply additional income or loss from a variety of other sources. This includes rental real estate income, royalty income, partnerships, S corporations, estates, trusts, Remics, which are technically real estate mortgage investment conduits. The other common theme to these is that for most taxpayers, a lot of these are considered to be passive activities. So they are subject to certain rules when it comes to loss deductions. For example, there are passive activity rules about how you can offset passive losses against only passive gains. There are rules about at-risk capital. So if you have an investment in a business that is not necessarily at risk or it's protected against loss, then you might be subject to certain limitations. So as we go through Schedule E, we'll kind of flesh out all of those areas, and then we'll get to income figures that you can then put onto your Form 1040. So there are 5 parts to Schedule E. Most taxpayers will not fill in all 5 parts, but I'll go over them briefly, and then we'll circle back and begin with Part 1 at the top of page 1. So this is a 2-page tax form. At the top of page 1 is Part 1, Income or Loss from Rental Real Estate and Royalties. This is the largest section of the form, and once we get through Part 1, the rest of it is fairly straightforward. So page 2 contains the rest of the parts. So Part 2 is income or loss from partnerships and S corporations. Part 3 is income or loss from estates and trusts. Part 4 is income or loss from Remics. And then Part 5 is a summary where we combine all of these income sources and then we enter them on the respective line for your tax return. So let's circle back to the top, and we'll start with our hero, John Doe, reporting income from all of these activities. But we'll start with Part 1, his income or loss from rental real estate and royalties. So before you begin, you should definitely make sure that you're reporting on the right schedule, because there are certain tax situations that might warrant certain taxpayers to use Schedule C instead of Schedule E. So we'll start with a note at the top of the form, and then we'll cover some other items that are covered in this form instructions. If you're in the business of renting personal property, for example, if you rent beach furniture at the beach, you would use Schedule C to report your personal property rental income. If your rental of personal property happens to be furniture that's included in your rental real estate, that doesn't necessarily count. That it has to be a very specific, purposeful use of the personal property, not necessarily incidental to your rental real estate. So farmers should report any farm rental income or loss on IRS Form 4835. That's the tax form, literally, that says farm rental income and expenses. So you would use that. Farmers would also use Schedule F, which is profit or loss from farming activities. And between those two, they would cover the gamut of farming that would need to be reported. Estates and trusts will report farm rental income and expenses on Schedule E because they do not use either IRS Form 4835 or Schedule F. There are certain instances of when you would need to use Schedule C. I covered the personal property rental business. If you provided significant services to your customer when it comes to rental real estate, so specifically IRS Publication 527, which governs residential rental property, clearly defines significant or substantial services to include certain activities such as regular cleaning services, maid service, changing linens. For example, a lot of Airbnb rentals might actually fall under this category because that might be part of your service that you provide. Again, you would need to dig deeper into Publication 527 to be sure where you stand depending on your tax situation. And then finally, certain rental real estate activities for, actually two more, rental real estate activities for real estate dealers. So for rental property that is in their inventory for sale versus income producing property. There is a difference, and that difference is of intent. You would report incidental rental income for a property that you intend to sell as part of your business as a dealer. If you made some rental income on that kind of a property, you would report it on Schedule C. On Schedule E, you would report income base that's related to rent on a property that you actually are holding for rental purposes. So if you're a landlord on purpose versus maybe an accidental or an incidental landlord with an intent to eventually sell the property, you would need to probably work through the details with your tax professional to make sure you understand how you define yourself. And then finally, self-employed individuals that might be reporting royalty income. We're not going to discuss royalty income too much in this, but if you specifically are reporting royalty income that's directly related to your business activity as a writer, as an inventor, as an artist, then you would report that on Schedule C since that's actually your primary activity. Now, before we go through all of this information in part one, there are two questions at the top. First, did you make any payments in the tax year that would require you to file a Form 1099? And generally, you're going to file Form 1099 if you paid anyone, any single person, $600 or more for services performed during the tax year. So if it was a non-employee that you paid, then you would file Form 1099-NEC. And if you paid money that was incidental to other work that was done, you might be filing IRS Form 1099 MISC as a miscellaneous. So be sure that you're aware of which version of the form you would file based on that tax situation. But if you do have to file 1099, then the answer to question B is pretty obvious. If you did have to file Form 1099, the only correct answer in this situation is yes. Otherwise, you can feel free to discuss that with your IRS examiner when they inevitably ask you why you would not file a required tax form. In this case, our hero John Doe did not file a 1099. He did not have anyone that he needed to pay a 1099 to. So in line 1, we're going to use this section to describe the property. So in line 1A, the physical address, street, city, state, zip code. In line 1B, we're going to enter the type of property that we are reporting on. So it's pretty straightforward. One is for single family residence, but if you're renting, say, a vacation house, that would be 3, for example. So if you are renting to yourself as a business owner, like you own a property and then you're renting it to a business that you own, that is what you would report in 7. In line 2, you're going to report for each property the number of fair rental days versus the number of personal use days. Now, the reason we'll do this is because there are certain tax treatment differences based on your answer. So we won't go too far into detail in this. For this tax year, for our hero John Doe, this property was completely rented for the entire year. He did not use this for personal use at all. The QJV box stands for a qualified joint venture. This is for a married couple that basically is acting as if they were a sole proprietor, except it's 2 people running a proprietorship, and this would be considered a qualified joint venture. Otherwise, it's treated like a partnership. The benefit of a qualified joint venture is that the IRS recognizes the tax situation here without requiring the taxpayer to file a completely separate Form 1065 as a partnership. They can simply report everything on their individual income tax returns, understanding that their air quotes partnership really is a qualified joint venture for tax purposes. Similar tax treatment, less paperwork. So now we're going to start reporting all of these different lines of income and expenses. Before we do that, I would like to point out that you can list up to 3 properties on each tax form, and if you have multiple properties, then you may consider creating a separate taxable entity and then hiring this out to an accountant. But all kidding aside, you would simply attach additional copies of Part 1 as applicable and listing your additional properties. And then when it comes time to summarize everything, then you would, in lines 23, 24, 25, 26, you would combine everything from all properties, right? So in line 3, you're going to enter the rent that you received for the tax year. You would use a separate income column for each item. In this situation, John Doe is only reporting on 1 property, but it's very easy to visualize what it would look like if he had properties in section row and column B, row and column C. If you need to report other income, you would report all income. So even if you rented a room, if you didn't rent the entire building, you would still report any rental income. If you received goods and services instead of cash, then you would report the fair market value. Line 4 for royalties. If you received $10 or more in royalties during the tax year, you should receive a Form 1099 MISC by February 1st of the following tax year. And then you would report that amount in line 4. Now, for all of these expenses, you can deduct what is considered to be an ordinary and necessary expense related to your real estate investments. You would enter the proper amount for each category, but you're not allowed to include either the cost of your own labor, even if you're a contractor that knows the value of an hour of your time. You can't use the value of your time as a placeholder for any of these expenses. You also cannot deduct any capital investments or improvements. You would have to capitalize those and then include them in depreciation. So you can't, for example, if you replaced an air conditioning unit, you would not be able to report that. You would be able to report an air conditioning unit repair simply by following the instructions for line 14. So anything that is designed to improve the value of your property would not be acceptable. Anything that you would use to either restore, improve your property, or adapt your property to a new or different use. So if you replace the roof on your property, you're restoring it in a significant sense, as opposed to having some roof shingles replaced. Replacing an AC filter would be under cleaning and maintenance, but replacing the air conditioner would be a capital expense. So in line 5, we'll enter any advertising expenses directly related. And for visualization purposes, we've included $1,000 nominal amount just to make things easier. But I will walk through line by line to kind of share what either additional forms or schedules you might need, or what special instructions might be in the Schedule E instructions. So in line 6, you can deduct ordinary and necessary auto and travel expenses, and you have several ways of being able to calculate them. So when it comes to travel, you can use any legitimate travel expenses. You can deduct up to 50% of meals that you incurred while you were traveling away from home in tax years 2023 and beyond. If you were kind of in this bubble of 2021 to 2022, you could deduct up to 100% of meal expenses for those 2 tax years, but starting in 2023 going forward, the limitation is 50%. When it comes to car expenses, you can deduct actual expenses incurred, or you can apply a standard mileage rate. So if you use more than 4 vehicles in your course of business, then you have to use the actual expenses method. If you have previously used the standard mileage rate, then you have to keep using that. You can't go back and forth. So I'll break down the actual expenses method, and then we'll kind of walk through the standard mileage rate. So in line 6, if you use actual expenses, then you would be able to deduct the cost of gas, oil, repairs, car insurance, tires, tolls, registrations, things of that nature. For depreciation, you can depreciate your car, but that would be a depreciation expense under line 18. You would also need to file and complete IRS Form 4562 to go along with your tax return. If you had auto or like lease payments, like auto rental, then you would list that on line 19, and you could do that. If you use the standard mileage rate, then the only actual expenses that you can include would be parking and tolls related to your travel. You cannot use any actual auto expenses. You cannot depreciate your vehicle. You cannot use rental or lease payments. You would simply have a standard mileage rate that you would apply right here. And for 2022, taxpayers have guidance of 58.5 cents per mile traveled for business between January and June, and then for July through December, the standard mileage rate is 62.5 cents per mile. And commuting is not considered a business expense, so going to and from your job. However, if you're a real estate professional, then you could have a home office. If you had a home office, you could consider driving to the real estate office once a week to check paperwork or to meet with a client. You would consider that part of your business mileage and not necessarily your commute. So the IRS publications contain a lot more information about how to calculate auto and travel costs. In line 7, you would enter any cleaning and maintenance that was related to each rental activity. In line 8, any commissions that you would have paid to real estate agents or other professionals that operate on a commission. Insurance, you would enter any insurance costs. For line 10, you can enter any legal or professional fees to include tax advice, tax preparation fees, but you cannot deduct any legal fees that were required to defend or protect your title, to recover any property, or to develop or improve property. Those fees must be capitalized and then added to your property's basis. So, the short-term gain on that deduction, goes away, but then you have the ability to add those costs to your basis, which, could impact your capital gains tax down the road because you'd have a higher basis that you would be able to deduct from your selling cost. In line 11, we're going to enter any management fees, property management fees, for example, that you might have paid to someone to just manage your rental property. In lines 12 and 13, we're going to enter mortgage paid. So in line 12, this is for mortgage interest paid to banks or financial institutions. You need to have documentation that shows how the proceeds of your outstanding mortgage or loan were used because you can only deduct mortgage interest as it's directly related to your rental property. Generally, your interest paid is not subject to a limitation on business interest unless your rental real estate activity is considered to be a trade or a business. So if that's the case, you would have to file IRS Form 8990. That would help you calculate any business interest deduction that you have to back out. Then you would have to complete that 8990. If there's a limitation, then you need to complete that form before you can report either on line 12 or line 13. So, if you would enter your total mortgage interest expenses also here on line 23C. So you'll see our $1,000 here also gets carried down here. If you prepaid interest, you can't deduct it when you paid it. You can only deduct it in the year that it applies. So even if you prepaid interest in 2023 that spills over to 2024, you would only be able to deduct the portion that corresponds to tax year 2023. Points to include loan origination fees that are charged only for the use of money must be deducted over the life of the loan. You can't expense that in 1 year. You have to amortize those loan points over the life of the loan. If you paid more than $600, you should receive a Form 1098 from your financial institution. And if you paid more interest than your Form 1098 shows, then you would need to go through the details in IRS Publication 535 to determine whether or not you can deduct part or all of the additional interest. So if so, then you would enter that amount here, and then you would attach a written explanation to your tax return. Then in line 13, using the same guidelines as in line 12, if you paid non-mortgage interest on debt that was related to your business property, this could be like seller financing. For a lot of real estate investors, that might be part of the negotiation. So if you are reporting that kind of interest, you'll do that in line 13. Line 14, repair costs. Again, the difference between repairs and capital improvements. Generally speaking, repair and maintenance costs are simply to keep the property in an efficient operating condition. Capital improvements have to be capitalized and then depreciated. Line 15, you'll report the cost of any supplies related to your rental business. In line 16, you'll enter any taxes that are directly attributable to each property. For line 17, you'll enter the cost of utilities. There is one specific instruction as it relates to telephones. As dated as this might sound, the IRS considers the first telephone bill of a taxpayer's residence or a home office to be a personal phone. So if you operate a home office, your landline or your first cell phone line would be considered a personal expense. However, if you have multiple lines, like if you had a home phone and then you had a home office phone, or if you had a cell phone used strictly for business purposes, that second phone and any taxes or fees attributable to that would be allowable as a deduction here. In line 18, you'll enter any depreciation expense. You'll also enter that down here in line 23. You might need to use IRS form 4562. Actually, you will. That calculates and reports depreciation and amortization. So you must complete it if you're claiming a depreciation on property first placed into service during the tax year, if you're depreciating listed property to include vehicles, or if you're taking a Section 179 expense deduction where you can deduct a significant amount of the cost of certain expenditures in 1 year instead of having to deduct or depreciate them over the expected life of that item. Land, however, is not depreciable. So when you do depreciate your property, you're going to have to be very careful about the depreciation value that you apply to the tax basis of the land versus the basis of the house or the building, so that you're properly depreciating it. If you're not a tax professional, this is probably where I would definitely enlist the assistance of a tax professional. In line 19, you might include any other ordinary and necessary expenses. For example, the auto lease expenses that we previously mentioned. Revenue Procedure 22-14 contains additional details about if you decided to make energy improvement, any energy efficiency improvements to a commercial building, for example, you would be able to deduct that here. In line 20, we're going to add all of these items and we get to a sum of $15,000. We would subtract line 20 from our rents received and if we had any royalties. So we do that and we arrive at $15,000. If you have a loss, then you would need to follow the form instructions, IRS Form 6198, if you have any at-risk loss limitations, then you would need to enter the deductible amount of your loss here, enter IRS Form 6198 here, and then you would attach your completed form with your tax return. In line 22, you'll enter any deductible rental real estate loss after limitations, which you would apply using IRS Form 8582, which is for passive activity loss limitations. So if you're limited by passive activity rules, then you would enter the allowable deduction here. So in line 23, we're going to report all rental income on 23A, all royalty income on 23B, And again, all of these are fairly summarized because we're only using one column. For line 12, that is the mortgage interest to financial institutions for all properties. Line 18 is your depreciation expense. Also, depletion expense for those taxpayers who are interested in oil and mineral depletion rights. I apologize for the short mention to all of you esteemed taxpayers. In line 20, that's the total expenses across all columns. So in line 24, we're going to enter the positive amounts from line 21. So all income for each property, we'll summarize that here. Any royalty losses from line 21 or any rental real estate losses from line 22, we would enter those here. So we've got a $2,000 loss here, and then we net those together. We enter the result on Schedule 1, line 5. If you don't have supplemental income from any of the other sources. So partnerships, S corporations, estates, trusts, remix. If you're not in the business of leasing out your farm, if you're not claiming any farm rental expenses, then you would stop here, report it on Schedule 1. Otherwise, we're going to just keep on going. But this number right here will also be included in the calculation for line 41. Okay? So take a deep breath. We're finished with part 1. The rest of this is applicable specifically if you think it's applicable. If you're not a partner or an S corporation shareholder, you can skip part 2. And then when we get to estates and trusts, anyone that isn't a beneficiary of an estate or trust can skip part 3. Most people can probably skip 4 unless you actually have income or a loss from a remic. So let's go with part 2. So are you reporting any loss that was not allowed in a prior tax year, either due to at-risk or basis limitations? If there's a prior year unallowed loss from a passive activity, or if you have unreimbursed partnership expenses. So John Doe does not have any of those limitations. However, we'll go over them briefly and then we'll move on. If you had losses that weren't allowed in a prior tax year due to basis or at-risk rules, you would enter your total unallowed losses that are now deductible on a separate line in column I. So right here. Then you would put PYA in the name column of the same line. You can't net those with any current year amounts. So if you had like PYA and then you would enter $1,000 loss, that's how you would report that if you had a loss that was previously disallowed due to basis or at-risk rules. If you had prior year unallowed losses from a passive activity that were not reported on Form 8582, you would do the same thing. You would report everything in column G. Actually, these would be parentheses numbers, and then you would put PYA. And you might have a prior year unallowed loss that you can now deduct because you either did not have an overall loss from passive activities and now you have passive income to offset your loss, or if you divested your entire interest in the passive activity in a fully taxable transaction, then once you divest yourself of that passive activity, you can deduct the entire loss. And then finally, for unreimbursed partnership expenses, if they are from a passive activity and you must file IRS Form 8582, you should do that. However, if you have unreimbursed partnership expenses from non-passive activities, you would enter that in column I, and then you would enter in column E of that same name, UPE, which stands for unreimbursed partnership expenses, and that's how you would do that. Assuming that none of those apply to you, then we'll kind of give guidance on how to complete line 8. It's pretty simple. You would enter, in this case, John's a shareholder. He's an S Corporation shareholder in Acme Enterprises. He would check here if this was a foreign partnership, which it is not. The employer identification number goes in column D. You would check E only if basis computation is required, and you would only check column F if there's an amount of your investment that is not considered to be at risk. In this case, neither of those apply. We've entered $1,000 of passive loss allowed. That he's also filing IRS Form 8582 to report. He's got passive income of $2,000 from his Schedule K1. He's also got a non-passive loss allowed of $1,000 from his Schedule K1, and that will offset his non-passive income. So these two will offset. His passive income exceeds his passive loss here in column G, but realistically we're going to net these together. We've got $2,000 in column H, $1,000 in column K, and then in line 29B, we're going to total column G and column I. Lines 30 and 31, we're going to add those two columns together. So the line 29A items are $3,000 of income, and then columns G, I, and J reported in line B or 29B. That adds up to $2,000. We will net those together, and we've got $1,000 of total S Corporation income. So now we'll move on to part 3. Poor John Doe also is the beneficiary of the Doe Trust. And it's decent money, but he really is kind of annoyed by this tax reporting. He could always just not accept the money, and then he wouldn't have to report it. So in column A, a lot of this looks very similar to part 2, and part 4 will look similar to this, even more streamlined. There are a couple of columns that we don't need to include here that were includable in part 2. So we'll enter the name of the trust in column A, the employer identification number in column B, and then passive deduction or loss allowed, again with your completed Form 8582. That goes in column C. Any passive income from Schedule K1 comes from column D. Any deduction or loss from the K1 goes into column E, and then other income that is not considered passive income on the Schedule K1 will go into column F. So just like we did before, we'll total everything and put it into the respective line on either 34A or 34B, the respective column, and then we'll net those together. So 34A, we add those two numbers together, and we get $3,000 of income. And then in line 34B, we've got $2,000 of loss or deduction, and that results in $1,000 of total income. And finally, John invested in something called the Lone Star Remic. He doesn't even know what it is. He just knows that he makes some money off of it. So in column A, he writes the name of it. Column B, he enters the employer identification number. And then from his Schedule Q, he'll enter the line 2C excess inclusion number in column C, taxable income in column D, and then income from line 3, 3B, that'll go into column E. So he'll combine those columns, just D and E. He'll enter the result here, and then he'll include it in his line 41 calculations. So in part 5, we're going to summarize everything, report it on the appropriate schedule, and then we'll walk through the last 2 lines. So John is not a farmer. He does not have anything to report from his IRS Form 4835, but if he did, He would enter that in line 40, and then he would complete line 42, which is the reconciliation of farming and fishing income. So for line 41, you're going to combine all of the sums of the previous four parts. So line 26 is for part 1, the rental activity, real estate activity and royalties. Part 2 is the partnership and S corporation income, line 32. Part 3 on line 37 is the estate and trust income, and then line 39 represents the part 4 income or loss from a remic. So we enter the total here in line 41, and that amount is $17,000. So I'll briefly go over lines 42 and 43, even though they don't pertain to our taxpayers' situation. So for farmers and for fishermen, they would enter gross farming and fishing income as reported on either IRS Form 4835, line 7, Schedule K1 from a partnership on Box 14, Code B, Schedule K1 from an S corporation, which is reported in Box 17, Code AD, and then a Schedule K1 from estates and trusts would go into Box 14, Code F. So, what does this mean? Well, generally, taxpayers will avoid any underpayment penalties if they're for farmers and for fishermen if their gross farming or fishing income for the current tax year or the previous tax year was at least 2/3 of their total gross income. And then if they file their tax return and pay their taxes due by March 1st of the following tax year. So this basically is a placeholder for farmers and fishermen to reconcile their farming and fishing income. In line 43, this is a similar method, reconciliation for real estate professionals. So a real estate professional is someone who's has spent more than half of their personal services were performed in a trade, were in real property or in businesses where the taxpayer materially participated under the passive activity loss rules. And the taxpayer performed more than 750 hours in the real property trades or businesses. So, for married taxpayers, each spouse has to meet that requirement without respect to the other spouse. So you would report this net income or loss on your you would enter your net income or loss that you reported anywhere on your Form 1040 from all rental real estate activities. You would put that in line 43. So that's all we have for Schedule E. Our show notes will contain links to some of the other videos and articles we've written about forms mentioned here. A lot of different tax forms that were mentioned. We'll put those in the show notes. If you, we'll also put a link in the show notes to the article that we've written about Schedule E. You can find that article and all the other articles on our website. Simply go to teachmepersonalfinance.com, type in IRS Schedule E or the applicable form number, for example, IRS Form 4835 for farm rental income, to learn more about that particular schedule or tax form. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, please post them in the show notes and I will do my best to get back to you. Thank you very much and have a great day.